Hi folks, today we're going to be talking about mortgage-backed securities. And with me I've got Ben Hayward from TwentyFour Asset Management. TwentyFour Asset Management is an investment boutique that specialises in fixed income investments. Ben, thanks very much for joining us.
Thank you for having me.
Maybe if I can just ask you to talk about the fund that you run called the Monument Bond Fund that invests in mortgage-backed securities, and maybe just explain in simple terms what exactly mortgage-backed securities are.
Sure, no problem at all. Well, the Monument Bond Fund is our low-risk entry point into fixed income. It is set up to provide a decent return, but with very little exposure to capital risk for our investors. What it does is it invests in a portfolio of investment-grade RMBS, which come from Europe, including the UK, and potentially Australia as well. So it's not taking any risk in the emerging markets, it's not exposed to the US marketplace. RMBS as an asset class is part of fixed income, so they're bonds. They trade just like the rest of fixed income, over the counter, T+3 settlement. Instead of buying a bond that's issued by a corporate where you're exposed to that corporate's health, you're buying a bond where you essentially own mortgages, so mortgages lent to people like you and me on the high street. What does that give you as opposed to a corporate bond? Well, it gives you a very defined risk profile because all you're exposed to are those mortgages. How do they work? Well, if you imagine, as you can see in the diagram, that you have a pool of properties with a current market value of £1 billion, those mortgages will all come from one particular lender. So let's say, for example, it's Barclays. And those mortgages in aggregate at the moment might owe £720 million to Barclays. So the first thing you can tell from that is that you have a weighted average loan to value, which is a key measure of risk in mortgage lending, of 72%. In other words, the homeowner has 28% on average equity in that mortgage pool. So you can afford to see house prices go down by quite a long way before you're really exposed to whether people pay their mortgage or not. Those mortgages are then funded by the RMBS notes that we're talking about today. And those notes are split out by credit rating, which denotes the level of risk in each bond, from AAA at the top to potentially BBB at the bottom. And they're split out that way because what you do as a bondholder there, what you have is the right to all the cash flows from the mortgage pool. So as the mortgage borrower will make his monthly payment, the large bit of principal and that little bit of large bit of interest and the tiny bit of principal every month, those cash flows will come directly to the bondholders, and they'll pay me my coupon, my interest on my bond, and they'll pay me my principal over time. So I get my money back that I paid for the bond in the first place through those cash flows. And that'll happen in order of seniority. So the AAA bondholders are the lowest risk. They have that rating because they get the principal first and they get their interest first, and they only pass on the rest to the junior guys when they've had what they need. Conversely, the lowest rated bonds in the deal are lowly rated because they get their principal and interest last, but also if there are losses on the underlying mortgage pool, then those will filter up from the bottom. In other words, the BBB guys will be wiped out before the single A guys take any losses. Very importantly though with these transactions, and unusually for fixed income, they have a number of mechanisms built into them that will offset those losses in their entirety. So if you imagine, for example, that Barclays lends someone £100,000 to buy a £120,000 house, and over time that borrower defaults, and when Barclays go to sell the house, they only get £90,000 from the sale, so they're £10,000 short. Then typically that loss will be allocated to BBB note holders. But before that happens, there are a number of ways that the deal will offset that loss, and those are what we call excess interest or excess spread and a reserve fund. Excess spread is a very simple concept. If you imagine that everyone in the mortgage pool is on a fixed rate mortgage and they're paying 4% per annum, but in any one coupon period the notes only need a 3% payment, then you've got 1% of interest that you just don't need, and you pay that back to Barclays. That's Barclays' profit margin in the transaction, if you like. It's why they do the deal. But before you pay that money back to them, you would take £10,000 from it and you'd pay it to the note holders to offset that loss. Now, theoretically speaking, if you had enough people miss a payment in a month, then the excess spread could go down to zero. And if you still have that £10,000 loss, then you go to the reserve fund. The reserve fund is quite simply a bank account that is set up at the start of the transaction, funded by Barclays. So they pay the money into that. It's their money at risk, if you like. and you just take £10,000 out of that bank account. Now, Barclays can't touch it. It's purely owned by us until our bonds have matured. That money will then come out and pay us to offset the loss. And then in the future, if excess spread reappears, not only can you use that to cure future losses, but you can actually use it to rebuild the reserve fund if you want. The easy way to look at this, to think about this, is that given that the excess interest represents Barclays' P&L, profit and loss in the transaction, and the reserve fund represents their capital they've tied up in the transaction, they will lose all of that money in perpetuity before any bondholder loses a penny. And that creates a very, very powerful alignment of interests between the lender in the first place and the investors in the RMBS positions.
Now, some people watching this might think, well, mortgage-backed securities, isn't that the stuff that got us into the mess that we're currently in? So maybe if you were to talk about maybe some of the differences between the experience in the US and the types of structures that were in place there compared to what is available in Europe and the types of stuff that your fund invests in.
Of course. Through the credit crunch, through the last sort of 6 years we've been through in the markets, a lot of investments have changed in value quite considerably. And that can be for one of three main reasons. It could be because there is a big risk-off environment in the marketplace and everything moves in tandem. It could be because the people who owned those securities at that point in time became forced sellers, maybe because they had to borrow money to buy them in the first place. But the third reason is because you might have actually a fundamental risk with the credit quality of that bond, i.e., are you confident you're going to get paid your interest over time, and are you confident you're going to get your money back at maturity? And the big difference between the European marketplace and the US marketplace, which have both moved considerably in value over time, is that the European marketplace was to do with reasons 1 and 2, and the US marketplace's price moves were to do with reason number 3. And that's really because the credit quality and the structuring and the way those markets work, the US market worked, is very different to the European marketplace. There are three main differences, three main drivers of that performance difference between the two. The first is really about how mortgage legislation works in the different geographies. In the US, when you take out a mortgage, it's a non-recourse mortgage. And what that means is that the day you default on the mortgage, you give your keys to the lender. They can then do whatever they want with the property, but that's all they can do. So if they sell the property and they don't get their money back on the mortgage, then they have to wear the rest of that loss. And obviously, in lieu of the lender, actually it's the RMBS note holder that's wearing that loss for the lender. So if you compare that to the UK, if you default on mortgage debt in the UK, the lender can chase you. They'll sell your property first, but they can chase you for recoveries for a further 12 years. If you default in other geographies, notably Holland, the legislation is much more powerful. And not only will they sell your property, but you will find it impossible to get credit afterwards until the debt's extinguished. And they can also actually agree with your employer to take part of your pay packet until the debt's extinguished, and you have no say in that matter. It's a court-appointed right. So when you see that the legislation, or the quality of the legislation in the different geographies, you'll understand why the US has had a much higher loss experience than in Europe. So that's the first difference. The second difference really is to do with how the markets work. In the US, typically, if you get a mortgage, you go to your mortgage broker. He'll find you a mortgage with probably a regional bank in your area. The regional bank will then gather various mortgages together over time, build up their book, and then sell that en masse. But importantly, all that risk has been passed on. So the original lender, the guy who actually underwrote the mortgage in the first place, who said, yes, this person is worthy of a mortgage, has a credit profile that hits our standards, isn't exposed anymore. And I think that's a very powerful difference between the two marketplaces, because you don't have that alignment of interest. If there's no consideration for how mortgages perform after they've been sold on, then it's no surprise you get a difference in quality between the two. The third difference really, though, is between the types of mortgages that were involved in US RMBS and European RMBS. The majority of the European RMBS marketplace is prime mortgages. It is people walking into their high street branch of Barclays or Lloyds, whoever it might be, and who can prove their credit profile, who ticks the boxes in terms of affordability, who has a sizable deposit. And those are the mortgages that make up most of the marketplace. In the US, if you were that kind of borrower, then typically the bank would lend you the money, but then they would sell those mortgages to the US agencies, Fannie Mae and Freddie Mac, and they would then handle that risk thereafter. But anybody who wasn't of that quality would have been sold into an RMBS transaction. So in comparing the credit quality of borrowers in the majority of Europe and in the US transactions, there is clearly a very big difference between whether people could pay their money back in a stressed environment or couldn't. And again, that has been a big driver of the differential in performance.
And just to finish then, if I could maybe just finish off with the question on alignment of interest. So maybe if you could talk about the extent to which you and other people within 24 Asset Management are personally invested in the funds that you run.
Sure, no problem at all. We are very convinced about the relevance and about the profile of our funds and their ability to fulfil their return targets at 24. We're a partnership, and of the 9 partners, we all invest in our funds. I can tell you with our most recent launch, which was the 24 Income Fund earlier this year, the partners in aggregate between them invested a 7-figure number. And personally, all of my fixed income fund holdings are invested in 24 products to the tune of north of £150,000. So I put my money where my mouth is.
Great. Well, thanks very much for your time and talking us through all those issues. If anybody's interested in getting more information on the Monument Bond Fund or indeed the 24 Income Fund, please contact your broker for a copy of our notes on both of those. Thank you.